Hello everyone. Today we're going to be presenting the chapter 28. We are Mateo Puth, Juan José Gonzáles, Alejandro Ocampo, Federico Bohmer, and Daniel Streubel, and we're going to be talking about interest rate derivatives and the standard market model. So this is going to be our presentation. First we're going to do a brief introduction, then we're going to talk about bond options, interest rate caps and floors, European swap options, generalizations, and hedging interest rate derivatives. In the end, we're going to be making a brief conclusion. So what are interest rate derivatives? They are instruments whose payoffs are dependent in some way on the level of interest rates, which basically means that they have a value that is linked to the movements of an interest rate or rates, which may include futures, options, or swap contracts. They are more difficult to value than equity and foreign exchange derivatives for four reasons, which are that the behavior of an individual interest rate is more complicated than that of a stock price or an exchange rate. For the valuation of many products, it is necessary to develop a model describing the behavior of the entire zero coupon yield curve. Third, the volatilities of different points on the yield curve are different, and lastly, the interest rates are used for discounting the derivative as well as defining its payoff. But today in this chapter we will just be talking about the three most popular over-the-counter interest rate option products, which are bond options, interest rate caps and floors, and swap options.
So first, we're going to talk about bond options. This is an option to buy or sell a particular bond by a particular date for a particular price. This is basically the same we already know about options, but the underlying asset in this case will be a bond. It is used to hedge interest rates fluctuations, and it is traded over the counter. We have two major categories of the bond options. First is the embedded bond options, and second is the European bond options. In the embedded category, we have three different types. The callable bond, which is also known as redeemable bond, and this one contains provisions allowing the issuing firm to buy back the bond at a predetermined price at certain times in the future. This basically means that the issuer may redeem the bond before it reaches the stated maturity date. This may be beneficial to the bond issuer if interest rates are expected to fall. In this case, the issuer may redeem their bonds and issue new bonds with a lower coupon rate. Putable bonds is the second type of embedded bond options. This contains provisions that allow the holder to demand early redemption at a predetermined price at a certain time in the future. Finally, we have loans and deposits. This can be redeemed without a penalty at any time. Here we can see some examples of each of the three types of embedded bond options to understand it better. In the case of callable bonds, we can see that in a 10-year callable bond, there might be no call privilege for the first 2 years. This is known as the lockout period, and after that, the issuer might have the right to buy the bond back at a price of 110 in 3 or 4 years, 107.5 in 5 or 6 years, 106 in years 7 and 8, or 103 in years 9 and 10. As we can see, as the bond gets closer to the maturity date, the price decreases. The example for putable bonds is a very simple example where we can consider a 10-year bond where the holder has the right to be repaid at the end of 5 years. Finally, with loans and deposits, we can consider a 5-year fixed rate deposit with a financial institution that can be redeemed without penalty at any time, contains an American put option on a bond. The second big category in bond options would be the European options. Many over-the-counter bond options and some embedded bond options are European, so the forward bond price has a constant volatility in this case to value the option. We can use the Black's model to value these options, So we have the equations here where K is the strike price of the bond option, T is the time to maturity, B sub 0 is the bond price at time 0, and I is the present value of the coupons paid for the bond. As we can see, these equations, we already know them and we've seen them before. And here is one example to understand the European options better. So the example asks us to value a 1-year European put option on a 10-year bond. So we assume that the current value of the bond is $125, the strike price is 110, the 1-year interest rate is 10% per annum, the bond's forward price volatility is 8% per annum, and the present value of the coupons to be paid during the life of the option is 10. So we can find f sub 0, which is 127, this is the forward. We have the strike price, which is 110, and we have the volatility, which is 0.08. Then we can find D1 and D2. And finally, we can see that the put option would be $0.12. When referring to standard deviation and volatility of the bond options, we can see that the standard deviation today is 0. This is because there is no uncertainty about the bond's price today. And it is also 0 at the maturity, because there is no uncertainty either. This is because the bond's price will be equal to its face value. So we can see the standard deviation first increases and then decreases until it gets to maturity at 0. On the other hand, we can see that as the life of the option increases, the volatility decreases until getting to 0 in maturity. We have in the lower part of the slide the equation to calculate the volatility of the bond. This would be the standard deviation of logarithm of bond price at maturity of the option divided by the square root of the time to maturity of the option. Finally, the last topic we should talk about when thinking in bond options is yield volatility. Because the underlying asset of the option is a bond in this case, the volatility is a yield volatility instead of a price volatility. Here we can see how to convert from a price volatility to a yield volatility, where D is the modified duration of the bond, Y sub F is the forward yield, and Y sub 0 is the initial value. Here we have problem 28.8 from the book as an example to understand the yield volatilities. And it says, if the yield volatility for a 5-year put option on a bond maturing in 10 years' time is specified as 22%, how should the option be valued? Assume that based on today's interest rates, the modified duration of the bond at maturity of the option will be 4.2 years and the forward yield on the bond is 7%. The option should be valued using Black's model in the equation 28.2 that we have it here. And the volatility would be 4.2, which is the modified duration, in this case D, 0.07, which is the forward yield, in this case it would be Y sub F, and 0.22, which is 22%, which is the yield volatility of the put option. Finally, the price volatility for this bond would be 6.47%.
Interest rate cap is an OTC derivative where the buyer receives payments at the end of each period when the interest rate exceeds the strike. Whereas an interest rate floor is a similar contract where the buyer receives payments at the end of each period when the interest rate is below the strike. Caps and floors and floors are widely used to hedge against interest rate fluctuations. An interest rate cap is a financial contract between two parties that provides an interest rate ceiling or capo in the floating rate payments. An interest rate cap actually consists of a series of European call options, couplets, on interest rates. The buyer receives payments at the end of each period when the interest rate exceeds the strike. The payment's frequency could be monthly, quarterly, or semi-annually. An interest rate floor is a financial contract between two uh, parties that provides an interest rate floor on a floating rate payments. An interest rate floor actually consists of a series of European put options, floorlets, or interest rates. The buyer receives payments at the end of each period when the interest rate falls below the strike. The payment frequency could be monthly, quarterly, or semi-annually. The exercise is done automatically that is different from any other types of option. The buyer needs to pay an upfront premium to the seller. Caps. Caps are frequently purchased by issuers or floating rate debt who wish to protect themselves from the increased financing costs that will result from a decline in interest rate. Investors use caps and floors to hedge against the risk associated with floating interest rate. Cap holders will benefit from any risk in interest rates above the strike, while floor holders will benefit from any risk in interest rates above the strike. Cap holders get a payment when the underlying interest rate exceeds a specified strike rate. Example, let the strike be 2%. The cap buyer will get paid if LIBOR rose above 2%, otherwise he will receive nothing if LIBOR fell below it. The floor holders get a payment when the underlying interest rate falls below a specified strike rate. Example, let the strike be 2%, the floor buyer will get paid if LIBOR fell below 2%, otherwise he will receive nothing if LIBOR rose above it. Cap as portfolio of interest rate options. This is the equation. This expression is the payoff from a call option on the LIBOR rate observed at time t underscore k with a payoff occurring at time t underscore k plus 1. The cap is a portfolio on n such options. LIBOR rates are observed at times t underscore 1, t underscore 2 until t underscore n, and the corresponding payoffs occur at times t underscore 2, t underscore 3 until t underscore n plus 1. The n call options underlying the cap are known as caplets. Cap as a portfolio of bond rate options. This is the formula. This expression is the payoff from a put option with maturity t underscore k on a zero coupon bond with maturity t underscore k plus 1 when the face value of the bonds is L1 plus R underscore 2 delta underscore k and the strike price is L. It follows that an interest rate cap can be regarded as a portfolio of European put options on zero coupon bonds. Valuation of caps and floors. The first expression is a value of caplet and the second one is the value of floorlet. We are going to make an example with the first one, the value of caplet. The example is: consider a contract that caps the LIBOR interest rate on 10 million at 8% annum with quarterly compounding for 3 months starting in 1 year. This an caplet and could be one element of a cap. Suppose that the LIBOR swap euro curve is flat at 7% per annum with quarterly compounding, and the volatility of the 3-month forward rate underlying the caplet is 20% per annum. The continuously compound zero rate for a maturities is 6.9395%. So the parameters are f underscore k 0.07, delta underscore k 0.25, L 10, R underscore K equal to 0.08, T underscore K 1, T underscore K plus 1, 1.25. So the expression of the value of Cahpter D1 is equal to minus 0.5677, D2 is equal to D1 minus 0.2, that is equal to minus 0.2677. So the Cahpter price in millions is 0.25 plus 10 plus 0.9169 plus 0.07 n plus minus 0.5677 minus 0.08 plus n plus minus 0.7677. That is equal to 0.005162. It is 5 million. The result can also be obtained using the derivative software that Enrique gave us. Conclusions are: the interest rate caps are valued via the black model in the market. The forward rate is simple component. The first key to value a cap is to generate the cash flows. The cash flow generation is based on the start time, end time, and payment frequency, plus calendar holidays, business conventions, and whether sticky month end. Then you need to construct interest zero rate curve by bootstrapping the most liquid interest rate instruments in the market. The most common used yield curve is continuously compounded. Another key for accuracy pricing on outstanding cap floor in the construct and arbitrage free volatility surface. The actual period is calculated according to the start date and the end date of the cash flows plus the count convention.
So, to continue with the topic of valuation of cap and floors, it is important to talk about spot volatilities and flat volatilities. So, in this slide, we can see a figure that shows the typical pattern of spot and flat volatilities as a function of the maturity. The spot volatility maturity is the maturity of a caplet or a floorlet, and the flat volatility maturity is the maturity of caps or floors. As a conclusion of this figure, flat volatilities are akin to cumulative average of the spot volatilities and therefore exhibit less variability as we can see here. Also, we can observe a hump in both volatilities. The hump is observed both when the volatilities are implied from option prices and when they are calculated from historical data. There is no general agreement on the reason for the existence of this hump, but there is a possible explanation. Rates at the short end of the zero curve are controlled by central banks. By contrast, 2 and 3 years interest rates are determined to a large extent by the activities of the traders. These traders may be overreacting to the changes observed in the short rate and causing the volatility of these rates to be higher than the volatility of short rates. And we can see here in the 2-year and 3-year period maturity that there is the hump. Finally, for maturities beyond 2 and 3 years, the mean reversion of interest rates causes the volatility to decrease. Now, we talk about the theoretical justification for the model. So the principal assumption is that we are in a world that is forward risk neutral with respect to a zero coupon bond maturity at the time t k plus 1. The analysis done in previous chapter shows us that by making this assumption, the current value of any security is the expected value at time t k plus 1 multiplied by the price of a zero coupon bond maturing at time t k plus 1. It also shows us that the expected value of an interest rate lasting between times tk and tk plus 1 equals to the forward interest rate. The result presented in the past slide shows that the price of a couplet that provides a payoff at time tk plus 1 is as the following equation shows us. Having in consideration that ek K plus 1 is the expected value in the forward risk neutral world. The forward interest rate underlying the cap is assumed to have a constant volatility. And finally, that Rk is log normal with the standard deviation of sigma times the square root of Tk. The past equation becomes as we can see here in this slide, with d1 and d2 as they are shown here. We also can see in the right side of this slide how is the expected value in k plus 1 calculated. Concluding, this is the cap pricing model, so this shows us that we can discount at the Tk plus 1 maturity interest rate observed in the market today, providing we set the expected interest rate equal to the forward interest rate. Derivation can be used to price interest rate, cap, and floors using the Black's model. So, in the worksheet name cap and swap option, we have to select cap floors as the underlying type and the Black European as the pricing model as is shown in the present slide. So, here the zero curve input is used continually compounded rates, and the inputs of the models are the start and end of the period covered by the cap, the flat volatility, and the cap settlement frequency. The software calculates the payment dates by working back from the end of the period covered by the cap to the beginning. Also, the initial caplet or throttlet is assumed to cover a period of length between 0.5 and 1.5 times a regular period. Finally, we can talk about the day count conventions because they have some impact in this model. So, the formulas presented do not reflect the day count conventions. So, if the cap rate is expressed with an actual over 360 day count, this means that the time interval in the formulas should be replaced by the function for the time period between Tk and Tk plus 1, that is Ak. So the forward rate should be expressed as follows with an actual over 360 day count.
European swap options. Swap options or swaptions are options on interest rate swaps and are another popular type of interest rate option. They give the holder the right to enter into a certain interest rate swap at a certain time in the future. They can also be viewed as a type of bond option. They provide companies with a guarantee that the fixed rate of interest they will pay on a loan at some future time will not exceed some level. With a swaption, the company is able to benefit from favorable interest rate movements while acquiring protection from unfavorable interest rate movements. To give an example of how a swaption might be used, consider a company that knows that in 6 months it will enter into a 5-year floating rate loan agreement and knows that it will wish to swap the floating interest payments for fixed interest payments to convert the loan into a fixed rate loan. At a cost, the company could enter into a swaption giving it the right to receive 6-month LIBOR and pay a certain fixed rate of interest, say 8% per annum, for a 5-year period starting in 6 months. If the fixed rate exchange or floating on a regular 5-year swap in 6 months is less than 8% per annum, then the company does not exercise the swaption and enters into a swap agreement in the usual way. Instead, if the fixed rate exchange for floating on a regular 5-year swap in 6 months is greater than 8% per annum, the company exercises the swaption and obtains a swap at more favorable terms than those in the market. Now, valuation of European swap options. It is important to know that the swap rate for a particular maturity at a particular time is a fixed rate that would be exchanged for LIBOR in a newly issued swap with that maturity. The model, usually used to value a European option on a swap, assumes that the underlying swap rate at the maturity of the option is log normal. So you should consider that SK is a rate a holder has the right to pay, that he receives LIBOR and a swap that will last N years starting in T years, that M are the number of payments per year under the swap, and L is the notional principal. Usually, day count conventions may lead to the fixed payments under a swap being slightly different on each payment date. So this is why we will not take day count convention into note in the following slides. So we assume that each fixed payment on the swap is a fixed rate times LM. Suppose that the swap rate for an n-year swap starting at time t proves to be St. By comparing the cash flows on a swap where the fixed rate is St to the cash flows on a swap where the fixed rate is Sk, it can be seen that the payoff from the swaption consists of a series of cash flows equal to L divided by M times the maximum value between St minus Sk or 0. The cash flows are received M times per year for the n years of the life of the swap. Each cash flow is a payoff from a call option on St with strike price Sk. While a cap is a portfolio of options on interest rates, a swaption is a single option on the swap rate with repeated payoffs. The standard market model gives the value of a swaption where the holder has the right to pay S of k as the following equation, where D1 and D2 are the following. As you know, S of 0 is the forward swap rate at time 0, sigma is the volatility of the forward swap rate, and the sum of I equal 1 till m times n of P0 to T sub I is a discount factor for the m times m payoffs. This is a natural extension of Black's model. Defining A as a value of a contract that pays 1 divided by m at times T sub I, the value of the swaption becomes the following, where A is 1 divided by m times the sum of P of 0 till T sub I. If the swaption gives the holder the right to receive a fixed rate of S sub k instead of paying it, the payoff from the swaption is L divided by m times the maximum value of S sub k minus S sub k and 0. This is a put option on S sub t. As before, the payoffs are received at times T sub I. The standard market model gives the valuation of the swaption as the following equation. Here is an example. Suppose that the LIBOR yield curve is flat at 6% per annum with continuous compounding. Consider a swaption that gives the holder the right to pay 6.2% in a 3-year swap starting in 5 years. The volatility of the forward swap rate is 20%, and payments are made semi-annually, and the principal is 100 million. In this case, A is the following equation that gives 2.0035. The rate of 6% per annum with continuous compounding turns into 6.09% with semi-annual compounding, so S of 0 becomes 6.09%, giving the values of D1 and D2 as 0.1836 and minus 0.2636 respectively. Then, the value of the swaption would be $2.07 using the equation mentioned before. The next topic is broker quotes. Interdealer brokers provide tables of implied volatilities for European swaptions. The instruments underlying the quotes are usually at the money, in the sense that the strike swap rate equals the forward swap rate. The following table shows typical broker quotes provided for the US dollar market, where the life of the option is shown on the vertical scale and the life of the underlying swap at the maturity of the option is shown on the horizontal scale. The last topic of European swap options is the impact of day count conventions. In order to make the formulas more precise, we should consider day count conventions. The fixed rate for the swap underlying the swap option is expressed with a day count convention, such as actual divided by 365 or 30 divided by 360. For example, if T sub I minus 1 corresponds to March 1st and T sub I corresponds to September 1st, and the day count is actual divided by 365, A sub I equals 184 divided by 365. This giving 0.5041. Suppose that T sub 0 equals T and that for the applicable day count convention, the fraction corresponding to the time period between t sub I minus 1 and t sub 0 is a sub I. Using the previous formulas, A turns into the following equation. The forward swap rate S sub 0 then is given by solving the following equation.
We're gonna talk about the generalizations. So we have now presented the three different versions of Black's model, one for bond options, another one for caps, and the last one for swap options. So each of the models is internally consistent, but they are not consistent with each other. So the first generalization is to consider any instrument that provides a payoff at a time t on the value of a bond observed at time t. It's its current value times expected payoff, provided that expectations are calculated in a world where the expected price of a bond equals its forward price. Now the second generalization is to consider any instrument that provides a payoff at a time t asterisk dependent on the interest rate observed at time t for the period between t and t asterisk. So it's its current value times expected payoff, provided that expectations are calculated in a world where the expected value of the underlying interest rate is equal to the forward interest rate. Now the final generalization is to consider any instrument that provides a payoff in the form of annuity. So you suppose that the size of the annuity is determined at the time t as a function of the n-year swap rate at time t, and that the annuity lasts for n years, and the payment dates are for the annuity are the same as those for the swap. So this is the A, which is the current value of the annuity when payments are at the rate of $1 per year, times the expected payoff per year. Now, the expectations are taken in a world where the expected future swap rate equals the forward swap rate. We're going to present the hedging interest rate derivatives. Now this discusses how the material on chapter 18 can be extended to cover interest rate derivatives. So, first of all, in the context of interest rate derivatives, the delta risk is the risk associated with a shift in the zero curve. Now there are many ways in which the zero curve can shift, so there are many deltas that can be calculated. Now here are some alternatives to calculate this delta risk. So the first one is to calculate the impact of a basis point parallel shift in the zero curve. This is also known as the dollar duration. The second one is to calculate the impact of small changes in the quotes for each of the instruments used to construct the zero curve. Now this method, in practice, I mean, traders tend to prefer this approach, since the only way the zero curve can change is if the quote for one of the instruments used to compute the zero curve changes. So traders prefer this approach, since it feels that it makes sense to focus on the exposures arising from changes in the price of these instruments. Now the third alternative is to divide the zero curve in forward curves and into a number of sections or buckets. Now then, after you've divided the forward curve or zero curve into buckets, you can calculate the impact of shifting the rates in one bucket by 1 basis point, obviously keeping the rest of the initial term structure unchanged. And the final one is to carry out a principal component analysis, which is seen in section 21, which this handles the risk arising from groups of highly correlated market variables. Now, then you calculate a delta with respect to the changes in each of the first few factors. Normally, the principal component analysis gives you around 10 factors, so you just concentrate on the first 2 or 3. Now, when these deltas are calculated, there are many possible gamma measures. Now, a gamma is a second partial derivative in the form of a, as you can see there, where there are 10 choices for xj and xi. Now the pi corresponds to the portfolio value, and since there are many possible gamma measures, this may be an information overload. Now, some approaches to reduce this overload is to ignore cross gammas and focus on the 10 partial derivatives where I equals j. So you'll only have 10 choices. Another approach is to calculate a single gamma measure as the second partial derivative of the value of the portfolio with respect to a parallel shift in the zero curve. And the final one is to calculate gammas with respect to the first few factors in the principal component analysis. Now, the vega of a portfolio of interest rate derivatives measures its exposure to volatility changes. So, in order to calculate this vega, one approach is to calculate the impact on the portfolio of making the same small change to the black volatilities of all caps and European swap options. This, of course, assumes that one factor drives all volatilities and may be too simplistic. So a better idea is to carry out a principal component analysis on the volatilities of caps and swap options and calculate the vega measures corresponding to the first 2 or 3 factors. Now, to conclude this whole section, we have presented a Black's model, and its extensions provide a popular approach for valuing European-style interest rate options. Now, the essence is that the value of the variable underlying the option is assumed to be log normal at the maturity of the option. It also assumes that the underlying bond price is log normal at the option's maturity, and for a cap, it assumes that the interest rate underlying each of the constituent caplets are log normally distributed. And finally, for a swap, it assumes that the underlying swap rate is log normally distributed. Now, this section also involves the calculation of the expected payoff based on the assumption that the expected value of a variable equals its forward value, and then discounting the expected payoff at the zero rate observed in the market today. Now, this is a correct procedure for the plain vanilla instruments we have considered. Normally, in practice, traders tend to prefer the second approach, because the only way the zero curve can change is if the quote for one of the instruments used to compute the zero curve changes. Now, this obviously is talking about the calculation of the deltas, which is a risk associated with a shift in the zero curve. Thank you.